So I woke up this morning, total anxiety moment. I mean, I'm 28 days into not owning the business I used to own, building this YouTube channel, sharing my knowledge and education with you. And what enters my mind? I'm not doing enough. I'm panicking. I'm like, oh crap. I need to be more intentional. I need to be more, here's what we're gonna do and blah, 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 blah. Because that's the world I've lived in for 20 some years. And so I just had a conversation with my wife and she goes, think about all your content you've created and where did it start and where did it end from? And how did it happen? And all the content I get responses from is content that just comes out of thin air compared to that panic content that I go, I gotta do this, this, and this. I get nothing from. So it's being intentional, but not intentional. So yesterday I took my daughter prom dress shopping, and I was the one who took her to buy her first prom dress, and I am the person who brought her to buy her last prom dress. And so I was really relaxed. I really enjoyed it. Such a great time. So in doing that, I had a great day yesterday. And then I woke up this morning in this complete panic. And, I gotta do this, I gotta work, blah, 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 blah. And what I realized was I need to bring this part of my life and this part of my life and get them to meet in the middle. It's the intentional, non-intentional approach that I believe you can apply not just to life, but to investing. And here's how I look at investing and how I'm trying to get to that middle ground with both investing and my life. So number one, where have my best trades come from? So to give you an example, recently I was listening to a research call and they were talking about Playboy, the men's magazine, and how they have gone through and restructured their business since Hugh Hefner died, and how they see the business going from a $300 million company to multi-billion-dollar company, and what they've done to do that. And after listening to the research call, I was like, oh, well, that makes complete sense about how they're restructuring the business and how they're going about it. So I went and I took a pretty full-size position in it, 6%, because I really believed in the concept. And so I did that. And a week later, Monday, I sold it with a 59% return on it. Crazy, right? Now, why did that happen? What was my process in doing that? And how can I apply that to future investment strategies so I can bring both this side of my life and this side of my life together? So one thing I've learned about my personality is that I don't need to necessarily be involved in trading every day. It's just not who I am, it's not how I function. But rather, I'm more of an idea, work through that idea, come to a conclusion, build a strategy, and then implement it, and then monitor it, and then once it hits the end point, I sell it. So I've decided, I was giving you that example of the Playboy trade, PLBY is the symbol, and when I heard the explanation of why this company is reinventing, how it's reinventing itself and how it could go through the roof, I was like, well, this makes complete sense. And so I went, did additional research, picked my entry point, put my order in, the entry point executed, I put my exit point, and I then followed it, and as the week went on, I was like blown away, number one, at the movement in a week, but also that I had made a great return on it. And then the decision to say, well, should I ride it? Should I keep going? And I thought, no, this is ridiculous. I've made a ton of money on this. This is a ridiculous trade. If I did 10 of these a year, I'd cover my income and my needs, everything, right? So I just sold it. I was out. I've had no regrets since doing that. For me, that is the trade. Now, on the downside, if it had gone negative, what would I have done? The downside, I've started to apply the between 4 and 6% downside risk. So I put my stops depending on how much volatility is involved in the position, how far down could it move before it made a move up. I determined that, and I set it between 4 and 6%. Now, some people would say, well, I'd be out of it in a heartbeat. And you're right, I'll be out of it in a heartbeat. But what I don't want to do is get caught up in the emotional side of things and say, I'm just going to ride it out. It's still a good play, blah, blah, blah. And then be down 19%. And if you've checked out my last video on Coinbase, guess what? And now I'm waiting that out. So it's really a predicament. And I think emotionally you have to eliminate the emotional side of it. So 4 to 6%, don't care, in and out, whatever. But the long run, I mean, think about it. You're out 4%. You have to get basically 8% return to make that back up. Chances are you're going to make that back up in a heartbeat. So you just do it. And that's where taking the emotions out of your trading is really the key. Now, for me, I'm realizing more and more that I am willing to wait. And I'm willing to sit in cash with my whole portfolio until the right time. Because think about it. If I made, say, 20 trades a year and they equaled out big returns, 20+%, that would be a great year, right? So it's a matter of patience. That's what I just need to do. And so for me, that is more and more where I'm going with my investing. But you have to determine what is best for you. So building a set of rules, risk managing is really the key. And this goes for all types of investments. If it is stocks, bonds, futures, options, future traders. I know somebody just recently asked me to do a video on future trading and what to do. I don't trade futures, but I think the same concepts of build a risk management strategy, determine how much you're willing to lose, and in most cases, like in futures, they move so fast, maybe a 2% downside protection. And really looking for those asymmetrical trades should be your play. Minimizing the amount of capital you put in. Say maybe you allocate 1 to 3% of your capital to each trade, but you risk manage around it. So let's just review the steps to creating a risk management investment process. Number one, what's your personality? What kind of investor are you? Are you a day trader, a scalper, a minute trader, or are you more of an investor? Seeking event ideas, seeking companies that are going to make moves over the intermediate term, or are you just a full-on long-term investor who buy and holds? Determine what that is. Number two, once you've determined your personality and the type of investing that meets your guidelines and meets your expectations, build a process, a risk managed process around how your personality matches up with your process, and incorporate risk management. I think this is so key is the risk management strategy that you implement with your investment philosophy. So how are you going to enter an investment? How much are you going to allocate to that investment? How are you going to protect the downside? What are you willing to lose, and how long are you willing to wait? The other side of it is, when you have mapped out your investment trade, how much are you looking to gain? What is the probability of hitting those big numbers, that high end? And once you get there, what is your exit strategy? Those are key in this. But most importantly, at the end of the day, it's about a process. And if you have a process to your investing and matches your personality, and you're willing to adjust that process as the world turns and the world changes, then you are ahead of the crowd and most likely will have great success in investing. So, create a process, match up with your personality, risk manage, and at the end of the day, live loud. I look forward to seeing you and hearing from you soon.